traders, Max here again from Learn the Price Action. Today the topic I want to discuss with you guys is how do you trade with the trend? How do you trade with the trend using daily charts, and how do you trade with the trend using 4-hour chart? What I want to focus on is there are two type of things we'll focus on. One is this static support and resistance, and one is a dynamic support and resistance. I will explain you what all the moving averages I'm using. Moving averages, I don't wait for the moving averages to cross over and just take a signal. No, what I do is I wait for a signal to form on the dynamic support and resistance, which is the moving averages, or the static support and resistance, which is the horizontal levels. Okay, so we'll go over the chart and we will understand how do we apply this methodology just by focusing on the daily chart. And if you are a more professional trader, you want to take more opportunities, you can drill down to the 4-hour chart and then make a trade on that. Okay, so let's go over that. In front of me I have a pound Aussie dollar chart, and what I'm looking here is a trend. Okay, like yes, everyone's looking here at a trend, but how do you take the trend? Okay, there are three lines that's important in a trend, which I generally draw. Okay, one is the 8-day moving exponential moving average, which is this red line right here. Second is the 21-day exponential moving average, which is this blue line right here. And the third is the 89 exponential moving average. Okay, by the way, these 8, 21, 89, these are Fibonacci numbers. Okay, they're very important and they are respected very well in the market on the higher time frames, like weekly, monthly, daily. They're really respected very well. Okay, so what I'm going to do is I'm going to show you how do you take a trade. Okay, now let's say, for example, you had this uptrend which was happening right here, and then after that you had some fallout that started to happen. Okay, and we will see where the fallout started to happen. Okay, so I'll start drawing for you. So you have this trend that's going up. Okay, so it breached this line right here. So the trend moved up, found a support, okay, found a support, and then over here, what happened? You see how these trend lines, which is the 8 and 21 exponential moving averages, they're kind of what is happening over here. This body right here, it pierced the 21 moving average, and the slope was, slope of the exponential moving was like that. Okay, what does that signify is that the trend is about to end. Okay, and over here still it hasn't. As long as the 8 and 21 EMA actually do not cross over, you still have, people still think it's an uptrend. I mean, it is valid, yes, it's an uptrend, but over here you can see the 21 moving exponential moving average, it just kind of came down. Okay, over here you can see right here. Okay, so what does that signify? That signifies that the trend is about to end. Okay, and over here was a confirmation where you had the 8-period moving average cross the 20 moving average right here. Now your bias is down. Okay, now how do you trade that? Okay, how do you trade? Like, you figure out that this trend is happening. How do you trade that? And I explained to you. So the first thing we're going to look for is a signal that happens either on the 8 exponential moving average or the 21 exponential moving average in the direction of the new trend. What is a new trend? New trend is coming down. Okay, right here. Okay, we figured it out that, okay, there's a big bearish body right here, and then we want to go short on this pair. Okay, so let's see how do we trade that. So next thing we see is that we have this beautiful pin bar that formed here. And where did that pin bar form? That pin bar formed on the 8 and also on the 21 moving average. So the 8 and the 21 moving average, they act as dynamic support and resistance. Okay, so any price action signal in the new trend or in the existing trend that happens on these lines, they are very powerful. So we have the signal that formed, and how do you enter that signal? That's another methodology. Okay, I'll teach you later. But for now, we can focus on the signals we want to trade. But let me go back. Okay, I'll explain you also how do you trade these trades as an advanced trader. So you found this signal. Now, how do you enter this signal? So you take the Fibonacci retracement of this signal, which is top to the bottom. And if you can bear with me for a second, I'll explain you some very fantastic thing that's happening. Okay, so we had the crossover that happened right here. Okay, over here there was a big pin bar that formed in the direction of the trend, new trend, right? And how do you trade that? You trade that by either putting your limit entry on the 38%, which is right here, or your limit entry at the 50%, which is right here. I generally tend to put at a 50%, but for a very, very fast market that want to go down very, very fast, the market may not retrace back to 50%. It may only retrace back to 38.2, and then would want to fall back from here. This is these levels, they are Fibonacci levels. So if you would have put your entry, let's say, right here, and then your stop loss would have been somewhere on top of this pin bar. Okay, so your risk would be, this is your risk, and what's going to be a reward, which will be 2 times that. Okay, so your reward was hit right here. If you would have put your reward as 2 times the reward. Okay, that's how you trade with the trend using dynamic support and resistance. Okay, now let's look at another example that's forming as the trend is coming down. Now, a lot of people will think that, okay, there's another crossover that happened here. Should we go long on the pair? It depends on the context, right? Like over here, yes, it looks very strong because there was a strong bullish move and people would want to move up. But what happened here is that it found a support again on the 89 exponential moving. So it was confirmed right here. Okay, but when you see the market, like, after this signal, and let's say you put your entry at a 50%. I'm just going to do it. Let's say you found this signal, and let's say you put your entry at the 50%. Okay, but next day you see this signal, 1, 2, 3, and over here is only one signal. So that means market doesn't want to move very fast up. So this is the things you have to pay attention to. So over here, mark 1, 2, 3. These bodies, yes, they're bullish, but is it like really as strong as this movement was? No, it's not. So that means that the previous bias that was short is still holding. Okay, so this is exactly what happened. So you have 1, 2, 3 up, and then boom, down. Okay, again bulls were trying, failed, trying, failed, trying, failed, and then again a pin bar right here. So when you have this pin bar, how do you trade that? Like I said again, you put your limit entry at the 50%, put your stop loss right here, and then you can ride the pair. And in this case, you would have easily achieved at least 6 times the reward. Okay, so that's one of the way of trading this. Now let's look at some of the signals that happen And by the way, after this one, it crossed the 89 exponential moving average. And then again, there was some retracement that happened right here. Okay, and then you had this beautiful piercing pattern that formed right here. And how do you trade the piercing pattern? Same methodology. You have to use the 50% retracement of the pair. Let's draw the Fibonacci for this. So you have top, the bottom, okay, and what you do is if you would have seen the signal, if you enter the market and if you would have seen the signal, you saw this body and you saw this one. You haven't seen this one, but you know that the trend is down, right? We figured it out from here. Okay, we read it that the bears are in control, and then we came down here, and then we saw here this beautiful piercing pattern form. So what do? You put your entry at 50%, which is right here. So you put your limit entry at 50%, and then wait for your order to get filled. So your stop loss can be on top of this. Okay. Next day your order was filled. Okay. And then what happened? 1, 2, 3, almost 3 times reward. Okay. So another winner. So this is how you read the market. So I'm going to show you a few other examples. And all these examples, they're happening where? They're happening at the dynamic support and resistance, which is the EMA. So this is happening at 89 EMA. All this pin bar is happening at the 21 EMA. And then this pin bar is supporting this piercing pattern that is happening, right? So this is all happening at the dynamic support and resistance. Over here again, okay, the market moved back up, okay, and where it formed support. It formed a resistance at 89 EMA, right? And how do you trade the pin bar? You trade the pin bar using the 50% rule, as I explained to you. You put your entry at 50%, put your stop loss here, and then you write the pair, okay? And then your target would have been hit. Your 2 times the reward would have been hit right here, okay? And then what happens is, then if you would have held your trade, I'll just explain to you. Yeah, if you would have held your trade, you would have actually made a beautiful winner right here, okay? Now, yes, there was another crossover that happened right here, okay? But is that a very strong crossover? No, because look, after this day, there was an opposite signal that formed, which was in line with the existing trend, right? So when it was aligned with the existing trend, you go short again. And that's what happened. People went short here. So now let's move forward and let's see what all the other things we can see right here. Another beautiful price action signal right here that formed with the existing trend. So you had a body and then you had inside bar. So you have another price action signal that I trade, or most of the professionals trade, is an inside bar, or some kind of a bar where the body and the tails are between the high and the low of the previous day. That's an inside bar. So that pair is forming an inside bar, and that it's also in the line with the existing trend. So how do you trade that pin bar? As I told you, if it was just a pin, it would have been a body like this, then what I would have done is I would have put my entry on the break of this inside bar and put my stop loss on it. But since in this case you have a pin bar, so what I'll do, I'll use my methodology of either 38% or 50% retracement, okay? So let's see how far it retraced. So let's see, I'm going to put an, sorry, right here. So over here, the price came between 50 and 60. I generally try to put my order 3 to 5 pips below the 50% so that I don't miss the chance of getting on board, because market sometimes may not come exactly here and it wants to just come back. And if it doesn't come back here 50% and wants to run away, that means it's got a strong downward move. Okay, people are impatient. People want to quickly get in the market and just move it into this direction, right here. So if you would have put your entry right here, stop loss right here, and then you would have made your target right here, right? So your target was hit right here, which is 2 times the reward. Okay, let's move forward and see what else we can find here. All right, so another beautiful signal that formed here. Actually, so many signals. I'll explain you one by one all these signals. So first signal is an Hikake pattern. What is an Hikake pattern? Hikake pattern is you have an inside bar, okay, and then on the third day the price moves up and it comes down and it closes below the high of this, okay, and that's what happened right here. Right here. Okay, so what is this? It's an Hikake pattern. That means people who thought that this is going to go long, they went up, but the market on the same day it came down. It closed below this. That means if you're looking as a breakout trader, people who were interested in breakout on the shorter time frame, like 4 hour or even 1 hour 15 minutes, they were all pooched because the market went against them, right? So this is one trade you could have taken. Another trade that formed right here is this bearish pin bar. And how do you trade Hikake pattern or the bearish pin bar? One of the way to trade Hikake pattern is you look at the break of the Hikake. Okay, so you would have entered right here, which is put a break on the Hikake and put your stop loss on top of the Hikake. And then your reward can be 2 times or even whatever the reward can be as your market is moving down, right? Let's say you put your reward 2 times the reward, okay? It was a beautiful winner and you got your target was hit by after a couple of days, about 1 week, and then you made some good reward, okay? And then what do you do now? Okay, so let's see for more. And this is diverging. I mean, you see the divergence here. So when the 8 and 21 EMA, they're diverging apart, they are like moving away. That means the signal trend is very, very strongly in that direction. Okay, so that means you may not want to wait for a 50% entry. Okay, you may want to have 38.2 entry or maybe 23% or whatever the entry market wants to give you at a pullback. So let's see the next pullback that happens. The next pullback that happens is right here. So market came down, came back up, and it found a support where? Found a support at the 8 exponential moving average. Okay, and how do you trade that? Like I said, you put your entry at the 38% right here, put your stop loss right here, and then 1, 2, 3, 4. Again and again, a lot of winner. Let's say even if you have a 3 times your reward right here, it was hit right here after a couple of days. Again, what do? You wait. You wait. And then what happens right here? The market came down, pushed back up, and what did it form? It formed another price action signal called an inside bar. Can you see that? This is the high of this body and this is the low. And this is between this. And how do you take the inside bar? Because this is a very fast trend, you can actually take the break of this inside bar and put your stop loss on top of this. Okay, so your reward can be 2 times the reward right here. Okay, but if you don't want to take an inside bar, that's absolutely up to you. You have to manage your risk and go from there. Again, let's look at some other price action signals. You had another price action signal that formed right here. What's that again? That's a pin bar. Again, 38.2% entry, just stop loss right here. Move 2 times R. Okay, and again, right here, put your entry at, in this case, now I'll explain you what is happening here. So as you can see, over here the retracement was only 38.2%, but over here the retracement has started to become 50%, okay, almost 50%. So your 2 times reward was hit right here, okay. So that means the market is kind of slowing down, like, you know, you can kind of judge that, okay, because the market is now coming back and testing, instead of 8 exponential moving average, it's testing a 21 exponential moving. That means kind of slowing down, okay. But again, what happened? A beautiful pin bar that formed. This was a winner, again another body that formed right here. How do you trade that? Put your entry in the 50%. Stop loss on top of this. Then 1, 2. Your market is, again, you're a winner, right? So again, you won that. Now over here, bodies, small bodies, going up. No, it's not a good signal. And then over here, what happened? Boom. Bulls came in and it closed above the 21 exponential moving average. Okay, once the close happens above the 21 moving average, you know that the signal may be temporarily moving up. Okay, and once that happens, you wait for the right opportunity to strike. Okay, and let's see what happens moving forward. And this is what happened exactly. So the price crossed here. So now what you do is that you want to look for opportunities to go long, right? So let me go and look at over here. It doesn't appear that there are many opportunities on daily chart, but how do you trade them on the 4-hourly chart now? So you can either look for opportunities on the retracement on the 4-hour, or you can look for opportunities of trading on the daily chart. Okay, so let's go down to the 4-hour chart and then kind of see what this this move is showing on the 4-hour. So I'm just going to draw that area right here. Just want to see that area right here. I think this was that big move that happened, and this was, yes, this is the one. Okay, now we saw that the price, this is, by the way, I plotted my daily exponential moving averages on the 4 hours. So this was the crossover we were talking about. So you had over here dynamic support and resistance comes in play, and also static support and resistance, right? So this was the last support that was this was the last breach that happened right here. So market came down and breached, okay, and it went sideways, boom, 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 sideways, 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 okay. And how do you enter that? How do you enter that? You enter that whenever the market, when it crosses out over, like on the daily chart, you look for a dip on the 4-hour, and you look at the dip on the 26 EMA. Okay, you look at a dip or some kind of action that happens closer to 26 EMA, and that's where you enter. Okay, let's say you found this body right here, and then you're like, well, I missed this. Okay, how do you enter? No, you did not entirely miss it. Okay, what you can do is you actually can wait for a little bit of retracement again, and look right here, another pin bar, and then some kind of a came down, and the market came back up again. Okay, and how do you enter that? You actually enter at a 50% right here, and put your stop loss below the last high, which is the last resistance right here, last support. So you put your stop loss right here, and then you wrote the market right here again. Okay, again, small bodies forming. That means this trend is end, temporary trend on this side is ending, and then the move is up again. Okay, over here again, what do we have here? This is another what's called piercing pattern. Okay, so piercing pattern is what? So you have this body one day, which is bearish, and then next day you have a bullish body that completely engulfs that. So I'm just going to draw it better for you. So piercing pattern is what? So you have this bearish body, next day the market comes down, and then it completely crushes the 50%. Okay, so and it closes above the 50% of this body right here. Okay, and this is the pattern that's forming right here. If you can look at it carefully, how you trade that? You trade it at 50% of this, and you put your entry right here. I'm going to actually zoom in and then make better sense of it. Yes. Okay. Okay, so let's draw the Fibonacci. Okay. And as you can see, the price, I'm just going to actually zoom in here. Maybe you can zoom in the window. Yes. So right here. So the price moved down. Next day the price going down and then breached, and it's actually above the 50%. Yeah, this was the 50% line right here of this body. Okay, and this one closed above this. Okay, so that means this is a piercing pattern right here. Okay, and how do you trade the piercing pattern? You trade the piercing pattern by using the high and using the low right here, and put your entry on the 50% of this. So you put your entry after you saw this piercing pattern, next hour you would have put your entry right here, put your stop loss below this, and you would have hit your targets 2 times the reward, and actually even 3 times the reward right here. That's how you trade on the 4-hourly chart, in line with the direction of your daily chart. Okay, so that's another three times your winner right here, 3 times your reward. Okay, so let's zoom out, and I'll explain to you even further how you trade even more, find more trading opportunities or not. Okay, as we can see, there was these lines right here are still diverging apart, and then of course this is a big sell-off, but next day bulls came back, pushed it higher. Next 4-hourly chart pushed it higher, and over here you have another price action signal. What is that? An inside bar. Okay, and where is this happening? This is happening on the 8 exponential moving of the daily chart. So this is our daily chart line, 8 EMA. Okay, and then this is our 26, okay, EMA, 4-hourly. Okay, and then what do you have here? An inside bar. What is an inside bar? This is an inside bar. How do you trade an inside bar? You put your entry in the break of it, put your stop loss, and then if you were to put your entry right here, put your stop loss even below this low right here. So if you put your entry right here, put your stop loss below the low of the last low. That would have been safe entry, safe stop loss. Okay, and then your reward could be 1, 2, 3, 4. So that means if you risk, let's say, $500, you made $2,000 in how many hours? 1, 2, 3, 4, 5, 6, 7, 8. That means in 1.5 days, you made $2,000. Okay, then a retracement right here. Okay, then you look for opportunity again. And what is this? You have again a piercing pattern right here. And where is this happening? This is happening again at the 26 EMA. Okay, and on the daily 8 EMA. And then what do we have? A price action right here. Right here. What is that? It's a small body. Okay, and then next day the market came, crushed it. It crushed the 50% of it. Okay, and even closed above it. Okay, that's a very strong signal. How do you trade that? Like I said, you still want to be stingy, and you just don't enter the market as it happens. You take the 50% off this. You take the low and you take the high, and you enter at 50%. Actually, 2 pips or 3 pips above the 50% would have been a good entry, because there is a difference between ask and bid price, which is a spread. So every time you enter the market, if you want to go long, you enter the market at a ask price. Okay, so you generally want to add about 2 pips, because sometimes the ask and the bid, the difference of the spread, you may not get enter. Okay, so generally add the spread to the 50%. So if the 50% is, let's say, 2.00610, you add a spread to that, which is about 2 pips or whatever the 3 pips is. Then you put your entry right here. Okay, so you would have put your entry, let's say 50% right here, stop loss below the low right here, and then again 1, 2, 3, 4 winner. So you gained 4 times $500, you gained $2,000. So in the next couple of days, you made so much money, which is unbelievable, right? So again, a price action signal right here, and this time it's happening. This signal is strong, and this is happening where? This is happening on the 12 EMA of the 4-hour chart. How do you enter the signal? You enter at the 50%, like I said. Put your stop loss right here, and then 1, 2. Your target was hit right here. Okay, 2 times the reward. Okay, guys, and then over here you have another reversal signal, which you could have taken, but I don't recommend generally taking the reverse signals on a 4-hour chart when the trend is very strong in one direction on a daily chart. But look at this reversal signal. This reversal signal was so strong, it actually moved the market in the opposite direction. And what is this reversal signal? The classical Hikake pattern, guys. This is the Hikake pattern. Okay, what is the Hikake pattern? A series of inside bars. That means consolidation, and the market wants to break up and then comes down. Okay, that's a Hikake pattern right here, guys. Okay, and this is it. This is the Hikake pattern right here. Okay, series of inside bars. Sorry, so this is an inside bar of this body, inside bar of this body, and then the price move up and then come down. This is a Hikake pattern. This is so strong, even it's happening in the 4-hour. But look, like bulls were not interested after Hikake pattern, because Hikake pattern itself, the psychology of Hikake pattern is that it wants to just go. It just wants to go in one direction, the direction it wants to take. It just wants to go. Okay, so as you can see right here, there was a movement that comes down right here. Again, a crossover happened on the daily chart right here, 8 and 21 EMA crossover, and then this is the pin bar that formed after that crossover. Okay, and how do you trade the 4-hour pin bar? I generally recommend that you put your entry at 38.38%, which would have hit after 2 days, but it would have hit. Okay, you would have had your entry right here. Okay, and then what would have been next day followed? Boom, 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 right here. Look at this move. So this is how you trade with the new trend or with the existing trend when the market is like trying to change a trend or trying to form a new trend. And this is exactly the way you trade. Okay, you trade on 8 exponential moving average, you trade on 21 exponential moving average, you trade on dynamic support and resistance. I'll give you an example of dynamic support and resistance over here. Yes, we were talking about the 8 and 21 EMA. Yes, we were talking about the 26 EMA on the 4-hour, but also it is forming what? It is forming a dynamic support and resistance, which is static lines right here. As you can see, the market moved up, it formed a static line right here, it formed a static line right here, it formed a static line right here, okay, it formed a static line right here, okay, and then over here, again, it's respecting these static lines, okay. You can use the static lines or you can use the dynamic support, and if they all align, the even a more stronger chart, stronger trend, stronger signal is. Okay, guys, so I hope you guys like this today's session. This was just to show you how do you trade with the trend using daily chart and also the 4-hourly chart. Okay, anyways, guys, take care, enjoy yourself, and happy trading. If you have any questions, feel free to email me or subscribe to my channel for further price action signals, for the price action training. And I'm more often now I'm trying to put more and more videos out on how to do the price action trading. Okay, thank you for watching and happy trading.